Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. Today we've got Scott with us. He's back. There we go. Got to do that. From Throne Reef Capital. Thanks for coming on, Scott. Really appreciate it. And looks like we're going to go over a couple of different things that we were talking about. Interest rates. Interest rates are important because that is a factor of pricing the market. Inflation goes up, interest rates chase it. At least that's my understanding of it. And then interest rates slow down when inflation slows down. So inflation is slowing down the rate of it, and we can see that in interest rates. And Scott and I were talking about it. He said he thinks it might go for a little while sideways or something. So what are you seeing, Scott? What's your opinions there?
Yes. So I think interest rate rise is, well, the futures market is basically saying that the interest rate rise might be done. And so if I just look at the CME Fed Watch, this is the futures market pricing in the probabilities of an interest rate hike. And so what you can see here is for the next Fed meeting, which is in February 2023, which is a couple of days away, 14 days away, actually, pretty close now, 94.7% of a 25 basis points, so 0.25% interest rate hike. And if you go further to March 2023, still the highest probability for, highest probability for a 0.25% rise. And then it really flattens out. Now, like you're looking at the futures market is pricing and cutting from March to May. So it's pretty much, it looks like the futures market is saying that interest rate hike is pretty much done. So you can see all the way across June, 4.75 to 5%, highest probability. July, 4.75 to 5%. And even if you stretch out way to December, we can see, actually highest probability for a rate drop by December, 4.25 to 4.5%. So I think interest rate hike might be done, Andy. And that's what that's what this is showing me. And we can get further support by looking at.
You're gonna go to the 2-year, right?
Chart. Yep. Yes, US 2-year. And so if I just turn this off, yeah, the Fed funds rate has finally. My mouse has suddenly stopped working. Okay, the US 2-year has pretty much caught up now. The Fed funds rate, has pretty much caught up with the US 2-year. And so what you can see here is this. So we were way behind the curve previously, behind inflation rate, behind the US 2-year rate. So the gap between these are huge, right? So I remember it was, the gap was like something like 3% at one stage or whatever. But now it's pretty much caught up. So US 2-year sitting at 4.28, Fed funds is sitting at 4.1. And so we are pretty much there, which means if the US 2-year is to stay relatively stable from this point onwards, we can expect the rate to flatten out for a period, I think. So that's what we're seeing.
Do you think we're going to go sideways for a little while? Do you think we're going to come back down? And what does this actually mean for our investments?
Yes, so basically with this, I think most of the time you will see it flatten out. So as you can see here, 2007 during the commodities bull market, it did flatten out for quite a period. So if I just do a measured move, a date range, let's say from this period to this period, it flattened out for ultimately 392 days, just over a year before it started dropping. And also, that's kind of a little bit strange period here, but from 2019 to the end of 2019, so for a period of about half a year, maybe somewhere around there, it did also flatten out as well. So 217 days or thereabouts. So yeah, I would expect this rate to flatten out, at least the Fed funds rate to flatten out. Maybe we'll see a little bit of wiggle in the US 2-year, just like this before the major fall. But I'm expecting if the history was to repeat, and there are periods where it flattened out for a long time. So if you see the entire period from 1995 to 2000, it flattened out for 5 years. So, it's not for me to really go and predict what's going to happen. But yes, I do expect it to flatten out before it, experiences a fall. And we're bound to experience a fall if the markets, if the smart money believe that there is trouble in the markets. And until we see that, I don't think we'll see a dramatic drop in the rates again, unless the delinquencies rates go up to cause trouble in the credit markets. I don't think we're gonna see a dramatic fall.
So you're expecting something where we go sideways for a little while. We continue to watch and monitor our metrics on delinquencies, foreclosures, all that stuff. And if we start to see the stresses in the market over there, we could then look at what we were just looking, the 2-year yield and the Fed funds. If that starts to decline with it, and while the other ones increase in their delinquencies and stuff, then we've got major problems, correct?
Yes, that's right. So what you will typically see is US 2-year, US 10-year, and so on, just starting to come down before the Fed funds rate. So you can see all the way throughout history, the US 2-year will always lead the Fed funds rate. So you can see here this period, for example, you can see a gap the other way around, which is US 2-year is way down here, the Fed funds is higher, right? So US 2-year led, so it went higher first when on the way up, and on the way down, it went down first. So basically, the Fed funds rate exactly follows the US 2-year pretty much all the time. As you can see here, it's very, very closely correlated. And basically, like if you've been following these markets for a while, then you'll know that it will pretty much on the dot, follow US 2-year. And so that's exactly what I expect to happen. And you will see US 10-year and so on also roll over together as well. So if I just put this on this chart here, you'll see everything roll over together. So this is US 10-year. I'll just delete everything off the screen. So you'll see US 10-year and US 2-year roll over together. And so every time you see the entire bond market roll over in terms of the interest rates, that's when you need to start thinking about timing the exit, I think.
No, I agree. Yeah, everyone, what they do is they see the inverted yield curve and they're like, sell, it's time to sell. Don't fight the Fed. It's like, guys, you are way early. We can still get a real big move out of this in a lot of different things, which could happen for another year or longer, depending on what these look like. This could go on for 2, 3, 4 years. We don't know what this is going to look like, so we just sit there and watch it as our leading indicator, at least the way that I would do it. What about you, Scott?
That's exactly right. That's exactly right. So if you look at this period, so I can just circle this period here. I mean, that's a period where the Fed funds rate, the US 2-year, US 10-year were generally flat across the board. Yet we've experienced this epic run in the NASDAQ market. So this is, the chart of NASDAQ down here below. So yes, I mean, you can have an epic bull run while the interest rates are going flat and while you do have inverted yield curve as well. So yeah, I wouldn't just look at it as an only indicator to time your exits or entries.
Well, back then we had was that an inverted yield curve? I think it was on the last portion there. It wasn't in the beginning, in the early 90s, it wasn't, or mid 90s. Because I see the 10-year over the 2-year there.
Yes, I will overlay this chart for you here. So it is T 10-year. So let's just go back to this and put this in. Ooh. And so I will just remove. Okay, so this is. Ooh.
I do that all the
This
time.
is the yield curve here, right here. And so what you can see is, and this is basically a period where the yield inverts. So you can see here, that was inversion. That was the initial inversion. It goes up and it goes down. So yield curve is going to look different all across different timeframes in history. But what you can see here is this was the initial inversion. It's not a big inversion like the 1970s or right now. But what you can see is that was the inversion, and then the NASDAQ market skyrocketed. And then obviously this was the inversion here. But yet the market still went up for a good period of 3 years. Here, it was probably longer than that. No, it was about 2 years as well. So, I mean, yield inversion happens. And in the 1970s, the important thing to remember is this probably threw everyone off. This is the 1970s style inversion, right? So what did that actually mean? It didn't really mean much for the Nasdaq market. It didn't really mean much for the commodities market. And that's why I think you can't really just look at the inversion. I mean, this is a crazy type of inversion like what we are seeing right now, similar. I don't think that's why you can't take this type of inversion and go, oh, there's definitely going to be a market crash, because we saw that 1970s had it and we didn't really see, any dramatic moves in the share market. I mean, if you look at the Dow Jones Industrial Average, for example, it just went flat for a period of like 10 years. So if I just put this on the new pane, all this period here where there was significant inversion, there was no market crash. The market instead just went sideways for a long time, and then started its bull market again. So you can't just look at the yield curve. I think yield curve, and I've mentioned this a couple of times, the reason why yield curve is important is because as the yield curve goes into an inversion, basically the incentive for the banks to loan out, create new loans lessens, because the margins on the new loans that are created lessens as well. So basically, it's the loan in the system that potentially experiences, I guess, a downward pressure. But if we don't have delinquencies, that creates further downward pressure in the total amount of money that's created in the economy. The yield inversion in itself doesn't necessarily have a contraction, an effect of contracting money supply in the system. So we need to take that into account. We can't just look at the yield curve alone.
So what are some of the sectors look like right now that you're watching and seeing? Do they look like they're about to maybe do a little bit of this, a little bit of moon up here? maybe
so.
Maybe a little bit of breaking of some patterns or something like that.
Yes, I mean, uranium looks really good. Obviously, hold on.
Yeah,
I'm a bit of a uranium fan, as you know. So uranium does look really good. I mean, there's a little bit of this is chart of Euro, and I think I went over this chart many times. But basically, we've broken out of this like long-term weekly trends, and we have squeezed up. We've broken above this trend. I mean, there's a little bit of a gap here, so we might come and fill this gap. Who knows what's going to happen in the short term? But I think we're ready to go higher. So I mean, and if it was to fill the gap, actually, we'll test right at the breakout points. So that would make a lot of sense from a technical perspective. So yes, I mean, uranium is mega bullish. And if you overlay uranium right now,
when we look at that chart right there,
yes,
what would you do?
I'm continuing to accumulate.
Yes, that's what we're doing. We're not telling
Yes.
anyone else to do that, but
yes,
we're obviously that looks very good.
Yes, I mean, for me, this entire zone, it doesn't really matter where I catch it. This entire zone here, like I can even expand it further and say this entire zone here is a buy point for me. Because if you look at other charts that looks very similar to this, and I've shown Apple chart a lot because I mean it just looks very similar, but you have many other charts that look very similar to this. I mean, for me, what I'm trying to say is, if you say this is a buy zone, this entire zone is a buy zone, like it really doesn't matter whether you catch it at the breakout point or down here, right here, because ultimately it goes on an epic run much higher than where you bought it. So for me, I just continue to accumulate around this zone. I think historically, if you look at the historical valuation of uranium compared to the last bull market, it's, I mean, for the amount of money that you're paying per pound in the ground for a lot of these developers, a lot of these producers, it's way below 2007 levels. So, I mean, you can't even compare, right? It's probably trading at like 1/20th in some of the names, 1/20th of the valuations that we've seen in 2007. So, I continue to accumulate, and I don't know. I think it's ready. So if you look at this Apple chart, and typically what happens is you've got, after a breakout, it consolidates for a little while. This is a typical pattern that you might see. Sometimes it doesn't, right? Sometimes it doesn't. Sometimes it does. Sometimes it comes down all the way to retest, let's say, this apex point. But like for me, it doesn't matter. Like, I mean, it's looking good. I just accumulate, because otherwise the cost of not actioning it while it's good enough. Like for me, when it's good enough, I just go and buy. It doesn't really matter if I experience a short-term downfall, because for me, if it's good enough, if the valuation is good enough, I just go and buy, because like the cost of not actioning something like this is that you missed out on a potential gain that looks something like this. And I'll just go over some more charts with you, because I mean, if you look at some of the other charts that look similar to this, where we've grinded around the 200 weekly moving average, and this is pretty similar to Euro right now as well, in that we have had initial breakout of this, long-term downtrend, or long-term sideways movement, and then you've had the initial breakout, and sometimes it doesn't retest. Sometimes it just continues to go up in this this uptrend, and it doesn't retest. So for me, I don't want to wait for the retest necessarily. I mean, I might have some cash on the sidelines, but I don't want to just like wait around and not action when for me the chart overall looks really good. And obviously the uranium fundamentals are just building up to be stronger and stronger over time. So
I think URA's chart looks better than TXN's chart here.
oh yes, I think so.
It
I mean,
really
it probably
does.
looks very similar to around this point here, actually. I mean, if you look at it, I mean, the initial breakout, and then, this is a bit of a triangle. You can draw something like this here. So yes, I mean, you can come down to retest, which I think is what Euro is trying to do. Maybe come down to, retest this breakout area like that to fill the gap maybe, and then it could just shoot up and do something crazy like this. Who knows? So I think Euro is really good. Euro is looking really good right now.
Yeah, we're seeing breakouts of other things too. It's not just uranium. We're seeing it in copper. Things are starting to move in copper. Things are starting to move in oil. Things are starting to move in all these different sectors. So I do like that. I see confluence of multiple sectors doing it, not just one sector. And I also think that the overall market, the stock market, doesn't look too bad either.
Yeah, that's right.
And when I look at that, that almost looks kind of like a Livermore cylinder to some extent.
Oh, like this?
You can see
it
it.
does actually. Yeah, I can see it. I can see it.
And then it comes down and
that
consolidates, and then it blows way up. Yep.
That is pretty clean, actually.
It is.
Yeah,
it is
it's very clean.
It is. See, you like what I see.
Yeah. Yes.
And uranium has that as well.
Yes, a lot of uranium names have this. Yes, they do. I mean, it's looking really good. And if I look at uranium right now compared to all other commodities, so U.UN divided by oil.
I'm gonna fire you up, Scott.
Look
at you
this.
Probably didn't see that Jesse Livermore on the Livermore cylinder on the oil. So now you're all fired up. You're like, oh, this is gonna go.
I know, I am super fired up. But if you look at this chart, which is uranium divided by oil price, I mean, uranium has a massive rounding bottom here against oil, and I think it's gonna outperform oil.
I know. I have positioned accordingly. Don't worry.
Yeah. And so for me, if it was to outperform, and this is a very long-term resistance right here as well. It dates all the way back to 2007. So for me, this is 3 times. So if we were to get back to these type of levels, the uranium price has to do 3x in terms of gains compared to oil. So that's looking really good. And
oil's at what, $80-ish, and then
yes,
uranium's at about 48.50, somewhere in that range there. And in order for these to get to the same level, uranium's going to outperform a little bit. So
yes,
and then the equities could obviously do better, but
yes, 100%. And so this is uranium to gold ratio. It's looking fantastic against gold. I mean, it's just like scraping the bottom right now still.
Yeah.
And so it still has to outperform gold. If we were to repeat 5x,
what about
6x?
What about this ratio here? Let me see if you like this one. Yes. OIH divided by URNM. So that's the energy service companies divided by the uranium companies.
It's a bit of a short history. OIH divided by, let's go, U.UN.
You could do Euro.
Yeah. Yeah, I mean,
You know,
OIH
OH
looks
looks
like it's
good.
a little, yeah. But I think one thing that we need to be careful of when we do ETF valuations, and that's why I continue to just use U.UN, is because of all the dilutions that's happened in the past, and with the ETF fees and things like that, the ETF of the old days. Like if I use URI as the basis, and if I go URI divided by SPX, for example, it can look massive, right? So this can look like, we need to go up like many, many folds. But I think what we've got to remember is because of all the dilutions during this period of time when it was in a downfall, or fees being taken out, like people selling off, and every time you kind of transact, it goes transaction fees and loss due to the spread between the buy and the sell and all those things. If you actually take all those things into account, I don't know if you can use these ETFs to measure ratios accurately. So that's why I tend to just use like U.UN, something that hasn't been diluted. So U.UN divided by OIH, for example. Let's try and do this. Okay, so yeah,
OIH
I
looks
don't
good.
OIH looks good. It does look good. But I would prefer to use something that hasn't been diluted to try and do the ratio analysis, if that makes sense.
Do you think what's coming up here shortly, do you think we're just gonna run like everything's gonna run together? Kind of like we had our beginning moves in uranium, oil, all that stuff, and then we kind of pulled back, and now it's like the overall markets, everything just runs. And uranium, oil, all this stuff, it's going to be like a cheetah in the wild, just sprinting, outpacing everything. While the S&P 500 is gonna be like, "Hey guys, wait up for me," as they just blow right by everything.
I 100% think that it can all run in one hit because of this. I mean, there's just so much money cash sitting on the sideline that it has to find a place to go. And as soon as like a market segment takes off, like commodities, for example, let's say silver takes off, gold takes off, this money will find its place in the commodities markets, I think. Because I mean, where else are you going to go, right? Because I mean, if you look at U.UN, which hasn't been really diluted,
Those are
divided
a
by
bunch of.
SPX,
What if those are a bunch of
look at that.
millennials that are saving up to buy homes? It could be.
Could
You
be,
don't know.
could be, but who knows? I mean, the most natural places for for this money to go to is something that's just starting off its bull run, right? Because that's where the money started to flow, and that's where where they're the markets that will attract the new buyers. So this money will need to find a place to go, and I think it's going to be the commodities market. Look at U.UN divided by SPX. I mean, this is crazy. I mean, we're not talking about something that's been heavily diluted either. And so we're looking at, against SPX, we're looking at 7x, or nearly 6.5x fold increase compared to SPX. So if it was to stay flat, we need to do 6 times the price of uranium right now, which will take it to $300 per pound. If we were to do something like,
we're going
yeah,
there.
I
Same
think
as
so.
oil. Oil's going 250, 300, 333. I don't know, whatever.
But I think yes, I think so. So against NASDAQ, we need to do more than 10x NASDAQ. So according to NASDAQ measure, uranium needs to do 10x from now, which takes it to 500. But I think the most objective measure is against money supply, right? If you think about it. So if I go U.UN divided by M2SL,
those could also go down. I mean, it could.
Yes. But it's a simple measure of how much money in the system is chasing uranium right now, and so it's and we're not taking into account the much better supply and deficit picture right now for the uranium case. We're not taking into account the energy crisis that we didn't see in 2007. So what we see here is just measured against the money supply and just assuming the uranium market's the same, and we just have triple the money chasing the amount of uranium right now, it needs to do almost 7-fold increase in uranium price, which takes the uranium price to $350 per pound. So I think there are so many measures that we can use that that suggest that uranium price is going to unbelievable heights. Let me just say unbelievable heights.
Yeah, that's good. I think we are going to go that high, though. I really do. I think we're going to go 300, 250, whatever it is. We're going a lot higher though. And I think we're starting, if you look at oil, we're starting to break that down. You know, we're right at the bottom of that Jesse Livermore cylinder. And I'm just like salivating here going, you know, man, this thing is getting close. We're breaking a down a falling wedge as well.
And look at this. Look at this. So if we just go, okay, could it get back to the 1970s level compared to M2 money supply, right? Because that's what we want to see as an objective measure.
Oh
Oil needs to go up sevenfold from the current level. So, you know, it needs to be at $560 per barrel, something like that.
And that's putting in kind of an inverted head and shoulders, isn't it? Kind of.
It is. It looks like it. It looks like it. It's a huge facing pattern as well. It's like, is this like a massive double bottom where you go, okay, the measured move is like way up here. I don't know. It could be. But as you can see, we're just scraping the bottom in these commodities. Like, I mean, it feels like they've gone up a lot, but if you actually do an objective measure against, you know, M2 money supply, against Dow Jones, against S&P 500 and so on, like we are in these commodities, we are really scraping the bottom here. Let's do gold divided by M2SL.
Yeah, it's doing a double bottom.
I mean that's gold, but
the big old one.
Or this, the entire thing, or this.
Yeah. I draw a line across, and it's a big double bottom. That's the way I view it.
But I mean, this is the craziest thing. Silver divided by M2SL. I'm sure this will look very impressive. Like, I mean, this is a massive double bottom. Look at this. Look at that.
It's the same thing. Same big old double bottom.
Yes. So yeah, I mean, these charts look crazy, and uranium would be somewhere like way up here. If we could get 1970s price and ratio against the M2 money supply, like, I mean, if you look at uranium price right now, it's it's undervalued compared to silver price. And yeah, if you take the 1970s price for uranium and do a measured move, I'm sure it's going to look absolutely crazy, bonkers, especially with the energy crisis.
I agree, and people, if there is an energy crisis that gets bad enough, people could run at precious metals because they're afraid that their currencies have problems. So
yes,
the setup is there.
The setup is 100%, I think. I mean,
now it's just, you know, when. And this indicates that it's going to take some time, though. It's not going to be immediate.
Yeah. This chart looks like it might take some time. But if we do go to weekly charts, it does. I mean, silver starts looking pretty good, right, on a weekly time frame, actually. So if I just go back to the candle and just put it back to this time frame, just a normal silver chart, for me, the reason why I'm so bullish is just because of the technical pattern here, which is we had a slingshot false breakdown below the 200 weekly moving average on silver chart. And so we could see something like this. I mean, we could come back and retest the 200 weekly moving average, because when you do have these slingshot type of patterns, you do come back and retest. And I can show you another time frame. So as you can see here, we had this zone where it spent weeks trying to retest the breakout area, right? 200 weekly moving average. And that's what we can potentially see in silver. But once that consolidation and retesting is done, like, I mean, it could move up very quickly. So looking at this time frame, we might not take that long. So let's say we are somewhere around this region here. If we were to repeat the velocity of increase in, I guess, the price movement, I mean, that's 2 years, which is not long at all. 2 years. So 770 days or thereabouts. And another time frame that I can show you in terms of when you have a false breakdown and when you retest that false breakdown area, I'll show you another time frame, because most of the times it will retest. It will do a retest. And so this is going back to the COVID breakdown here. This is when I got into silver and went very heavy into silver. This was the false breakdown. As you can see, there are lots of support around this area, and when it comes back above you pretty much know that it's going to be a false breakdown, that this entire thing was a false breakdown. And what it does is it came down for a couple of days to retest, but it wouldn't have been too late to buy into this. And look at what happened afterwards. So it had an epic run afterwards. And so on a weekly time frame, you can see similar things. So we've had, good distant 5 candle bars or something like that here, 6, 7. And so on a weekly time frame, we could do, and this is just hypothetical, like put in a big couple of weeks of, I guess, correction, retested the breakdown, the false breakdown area, and then go boom. So, or you could just do this and then go boom. So everything's looking really good in the commodity sector right now, Andy. I'm pretty excited.
We can't just go boom boom on silver.
Sorry?
We can't just go boom on silver right off the bat.
We could.
Or you think we're going to do a little bit of sideways?
But if you take the long-term view, it doesn't really matter where you buy it. So
Yeah,
silver miners are actually very undervalued against silver right now. Like if I just go SILJ divided by silver, like, I mean, in terms of the ratio of where the miners are trading at, we are like very low here, right? I mean, that was the COVID low right here. We're not quite there yet, but we are getting very low in terms of the silver junior miners valuation against silver. And if I do, let's say SIL divided by silver, which is the bigger ETF, we're right at the bottom here, right? So this is almost like a double bottom. So like, will I wait until it absolutely gets hammered to this level? Like, because that was the previous low. I don't know. Like, I mean, I continue to accumulate gold miners right now, gold miners, uranium, and silver miners, because for me, like, this is where I just say this is good enough for me to buy. I don't need to wait anymore. I mean, you can have a short-term pullback, but it doesn't matter.
I agree. It's down low, and I start accumulating. I get too. I'm always early, so I kind of sprinkle a little bit, and I start hitting it harder as it goes down into that area. Yeah. So I think. What else do you have to share, Scott? Anything else? I mean, that's we covered uranium there. We covered precious metals and oil, which I would say all look probably the best of any of the sectors. I don't know. I mean, gold, silver, platinum. You can pick any of the precious metals. They all look good. But is there anything else that you see in the markets that look good? Or what about emerging markets? Do you think that looks good? You're gonna shake your head, yes.
Emerging markets.
Emerging markets, EEM.
Hold on. Let me just show you copper.
It's going to look good.
So
you know you're going to like this one.
Copper miners ETF. Yeah, it's bounced beautifully off the 200 weekly moving average, and this is why I think this is such a critical zone. This 200 weekly moving average across all charts. Like, I mean, they act as major support in most charts. So it's really good because pretty much all the commodities, if you look at the bigger names and also the ETFs, they are bouncing off these 200 weekly moving average zones. I mean, you know, say for example,
that one's got a double bottom. So what people need to realize is these companies, these ETFs, these sectors, they're bottoming. They're putting in massive double bottoms. They put in an accumulation zone above the double bottom, and then they go into a new uptrend for many years. That's how it works. So that's what that bottoming process is. So you get a double bottom. Yep, that thing. It breaks out, it consolidates, and then we go into a big uptrend afterwards.
Yes.
They're all
100%.
All commodities are doing it. It's not just one or two commodities, it's everything. Uranium's doing it.
Yeah.
Oil's doing it.
Yeah.
Copper's doing it.
Yes.
Agribusiness or ag ETFs are doing it. On rare earth metals are doing it, et cetera, et cetera, et cetera. They're all doing it. And that's exactly what we're seeing in you, me, you know that one.
Yep.
It's got the double bottom, consolidation, and then
double
a big
bottom retest
run. Yep. That's a double bottom, the consolidation, and then you run. This is like the best time to be buying is to be, well, my opinion, is to be looking at these double bottoms and buying right off kind of that top where it consolidates and does a retest.
Yes, I agree. Yeah, I mean, yeah, this as you said, Andy, it's the confluence of all these commodities charts that's making me feel very, very bullish right now, because it's not just uranium that's kind of like starting to break out. I mean, oil's starting to get that support right off the 200 weekly moving average, as we've seen here. So that 200 weekly moving average has worked beautifully on this chart. Look at that.
And also,
I mean,
we
just
went
bouncing
over
off
the
right now.
we went over the beginning. The reason we went over the interest rates is to let you guys know, like, we're not at a high risk spot yet, at least in our opinion. We're not at a high risk spot of a crash yet. So we're getting positive signals in the market and all these different commodities, and we don't have that the deterioration of the market where we get a blowout, like big old deleveraging crash from the housing market. At least I don't see those factors yet. Doesn't mean it can't happen. I just don't see where it could happen from. So that's my take there. And so I think we're still okay. And if the Fed is going to increase interest rates, I think they still think we're okay as well.
Yes. And we don't need to get super complicated about this. I mean, you can just apply this data at your personal level and go, okay, so in 2007, we were at a major lows in terms of the household savings, how much they had in the checkable deposits, right? So if your bank account is really, really low, then obviously you're in trouble. And then that shows through the delinquency data, because delinquency is starting to pick up rapidly in 2007. So obviously you're saying, basically what this data is showing us is saying, it's saying 2007, record low of, amounts in the checkable deposit accounts, in trouble, right? Delinquency rate starting to pick up. It's actually it's actually transpiring in the delinquency rates, because people are actually saying, I can't pay back because I just don't have enough money in the bank accounts. But right now, like if you see this picture right here, you've got unprecedented amount of money in your bank accounts, like so much money you've never had before, right? So it's like literally from 2007 lows here, 129 billion, to here. What is that? Is that like 50 times more money?
Yeah, I think it's more than that.
Something like that. You've got like more than 50 times your money back in 2007, and your delinquency rate is not starting to pick up at all, right? There's no sign of it picking up right now. So I don't know how the crash can happen if we've got record low delinquency rates. That has no sign of showing that we might be going in the wrong direction. And also, if the checkable deposits savings is showing us that we've got unprecedented level of cash on the sideline. So I don't think we need to get super complicated with this. It's like just apply it at your personal level, and that makes interpretation really easy. Would you agree with that, Andy?
Yeah, basically what you're saying is checkable deposits means you're rich. You've got a bunch of cash sitting in the bank account, and then the saving rates, you're like, I'm not going to save any money. I'm rich. Like, I want to start spending money. So I think that we're going through that cycle where the checkable deposits are going to go down, your saving rates is going to go down. And then eventually, and I don't know when that time is, delinquencies start to come, foreclosures start to come, the housing market gets tired. We go to an overbuilt, oversupplied situation where we build too many homes, and we're just not there yet. Like it's just not there yet.
We're nowhere near that, right? So this is mortgage debt service payment as a percentage of disposable personal income. So in 2007, before the crisis, we're spending 7% of our total income on mortgage repayments. Right now, we're spending like 3.98%. So, like, I mean, and there was no housing crash like all around this zone, right? So all this zone, if you think about it, how much people are spending on mortgage repayments, we didn't see a housing crash anywhere here. So just to get to a point, I don't know, how long do you think it would take to get up to this level? It's going to take ages if you look at the charts alone. So I don't know where the crash is coming from. I don't know what people are talking about when they talk about
I think more new people have to buy homes at these higher rates for that to move up. And then that's probably an average. So it's going to take some time.
It's going to take a lot of time, I think.
But rates definitely went up quick. I will say that. I didn't expect mortgage rates to go up that fast. I thought we were going to hit like 4.5, 5, and it'll be like, okay, we're good here. And I thought that the housing market was going to be sustainable at that level. 7%. I was like, man, that went up really fast, and that's really high. And it has had an impact. Now we have to see in the normal busyness of the market, are buyers going to come in, and is it going to be okay? Because we just went through the weakest part of the real estate. We'll call it the mini cycle throughout the year that people don't buy. Now they're going to be coming, so we'll see if it firms up or if it doesn't.
I forget the exact stats though, Andy, but in the US, like something like 90% or something. I forget the exact stats, but 90% of the mortgages are fixed for a very long period, right? So,
Yeah.
I mean, the fact that mortgages went up just means, you know, if you had certain budget, you might have to lower, I guess, lower your standard in terms of the houses that you choose, but it doesn't really affect the existing mortgage payers, mortgages. So, for me, like I don't know how it leads to delinquencies if you haven't really experienced huge uptick in your repayments, because it doesn't affect any of the existing mortgages. So I don't know. I don't see it. maybe I'm just oblivious to all of this, but I just don't see how there can be a crash.
Right. Yeah, and maybe we get a slowdown later in like late 2023, early 2024. Maybe I don't know. We'll have to wait until we see what these things do, if it starts to roll over, and maybe we get a small recession. I don't think it'll be a blowout one. I mean, we have a lot of young people on YouTube, a lot of young people making all these predictions like we're just going to blow out 2008 like it's nothing, and house prices are going to be, I don't know, like 50 to 70% down. I mean, maybe that's possible if we have like some sort of bond crisis and interest rates go up uncontrollably or something. And I don't know. I don't know I don't know what they're envisioning for that to happen. I'm obviously in the wrong, I'm on the wrong boat in the wrong camp. I don't know, whatever than those guys. So I can't even I'm trying to understand the way that they're trying to view it, but I disagree with a lot of their assumptions, which is basically the market's going down a little bit and then they just project it like continuing for 3 years with no reasoning behind it. So I'm like, well, that doesn't make any sense to me. So
and I think one important thing to remember is, I mean, when people draw comparisons to 2008 crash, we have to remember that 2008 type of event is like once in a 20 to 50 year type of event. It doesn't happen every recession. Normally, recessions are much more subdued than the one that we saw in 2008. So it's I don't know, to immediately kind of start comparing today's scenario to 2008, I think is just incorrect. It's very misleading.
Yeah, and I'm gonna pull up a home builder, which a lot of people, what I would say if I take a big picture view, this is Lenner Corp, which is a big home builder, right? And I put it on logarithmic. It's been going up and up and up. We went into this consolidation period and broke to the upside, did a retest, and we're starting to move higher. This does not look like a topping pattern to me. A topping pattern looks like this. And this happened in 2005, in 2006, and then the peak here was 2007, and that was your bull trap before it just absolutely got hammered. I don't think we're doing that right now. I mean, is it possible? I mean, maybe this is a double top. I don't think so. It sure doesn't look like it to me. Usually what happens is you don't break these levels here. You don't go to a new level, you do a retest, and usually that retest it'll drop there, but we're going back higher. So if you're a technical analyst type person, you'd say, well, Lenner Corp looks really good. This looks good to go higher, which makes me think that the housing market and all the crash people are wrong. And we can look at that by looking at Lenner Corp, a home builder. We can also look at LGI Homes, and you're going to like this one, Scott. I'll go off logarithmic here. And what do you have here? Oh, that's the Livermore accumulation cylinder that's ready to rocket higher. So why do we have a Livermore accumulation cylinder in LGI Homes? And why does Lenner Corp look good? And why these other ones? Now, in the short term, the data might be bad. I completely agree with that. We could see a slowdown in new home sales. We can see all this stuff. And I agree with everyone that that everything is highly leveraged to the mortgage rate because we've seen such a gigantic increase in mortgage rates in a short period of time. The market has to adjust. And when interest rates start to come back down, and that's what we're looking at, the interest rates are going sideways on the 2-year. 10 years probably going to go sideways. Things need to adjust. It needs to basically, I'll say, chew on these higher interest rates. And when people realize that the interest rates may not go back down as far as what most people think, I think they're going to say screw it and start buying homes again. That's my take, because we have a shortage of homes, and right now it's affordability that's kind of slowing things down. It's not necessarily 100% the home price. There's two big components here, and the bigger of those components is the mortgage rate right now that just rapidly shot up, and everyone's trying to just digest it. That's my take.
I think so. I think that's exactly what's happening, especially in the US. I mean, because if you say, let's say your budget was like $3,000 in mortgage repayments per month, suddenly like you can only get a much lesser of a house with the same amount of budget. So, you know, people are just holding off, I think. And the thing is, it's backed up by data. So we're not just saying it for the sake of saying it, but, you know, mortgage delinquency rate, the most important measure, is very, very low, and there's no sign of it going up. So I think housing markets in, say, countries like Australia or Canada might be very different, because I think we could be Australia could be in a lot of trouble with the housing markets maybe this year. That's just my gut feel, because obviously a lot of the loans are becoming variable loans from middle of this year, from fixed loans, because we can only fix it over here in Australia. We can only fix it for 5 years maximum. So I think the housing market is very different in Australia, very highly leveraged. We're, we're priced compared to our peers like the UK or the US. I mean, our housing prices are just off the charts. So I think it's like in the top 3 most expensive places to buy houses in the world. So it's very different. But in the US, we had full cleans out in 2008. Delinquencies are low. The amount of money that people spend on mortgage repayments as percentage of disposable income is low, and so it's, I don't know, I don't see a crash in the US.
I agree. So that's all I've got for today. Thanks for coming on, Scott. Got anything else?
That's it. Jesus loves you. I guess that's it.
All right, guys, if you made it to the end, say thank you, Scott, for coming on in the comment section. And go check out his website. Go check out his Twitter. You can see it above him. And thank you for coming on. Oh, Scott, did you want to share any other news?
No, it's all good.
No, you're good? Okay. All right, that's all we got. So thanks for coming on, guys. Appreciate it. We'll catch you next time. This is Finding Value.
See you later.